Hey guys, welcome to Tradonics webinar number 3, official webinar number 3. And today we're going to look at support, resistance, and trend lines. Now, these are fairly simple, but there's a lot to it. I want to make sure that during the webinar we make sure that it's understood. What is support? What is resistance? What are trend lines? I have a manual for this, and it is fairly lengthy. It's longer than I thought it would be, actually. The manual for this one is bordering 50 pages. The PowerPoint version that you're looking at now is going to be, there are bits and pieces from the manual, and this PowerPoint itself is bordering on 90 slides. And I want to make sure that just all the information really gets across, that you understand support, resistance, and trend lines, because this is going to play a factor in some of your trading decisions. So with that being said, I want to make sure that this is going to cover all the bases. So let's get the slideshow started. And essentially, for the first part here, if we can get through this in an hour, it'll be the slideshows. I'm going to read from the text that I have and do the explanations of the charts and things. I'm going to try to keep this to about an hour. It might go a little bit over because there's a lot. There's a lot here. And if I drag it on for 2 hours or whatever, then it just becomes a little bit more difficult to absorb. So let's get the slideshow started from beginning. All right. John, you're asking for the manual. This right now is the PowerPoint, and I'm going to present that, but the manual version will be made available to you as well. All right. Support, resistance, and trend lines. Now, it's important that you understand a little bit about support and resistance and trend lines. Now, these are tools that traders have been using since the beginning of trading time, and that's no joke. They were valuable back then, and they are still valuable today. This was the very first kind of market assessment that was ever done because it works, and it has followed through right from the beginning to today. Support and resistance levels will give a trader a really good idea where price has a high probability of stalling, of turning around, or taking off. Ignoring these levels at the time of a trade would mean that the trader's taking an unnecessary risk and placing an uninformed trade. Being aware of these levels is going to present you with some decisions. Am I taking a trade that is too close to a level of support and resistance? If that's the case, that may mean that the trade's not going to go very far. It's going to butt up against that level and then stall. Are we taking a trade that bounces off a level? Well, a trade like that has some legs. It has some potential. Are we taking a trade that crosses a level? This also has some legs. Once we've determined that there is a trade setup, we will do very well to verify the trade signal by using either support or resistance or trend lines. And this is just what I was saying. The combination of support, resistance, and trend line is something that I refer to as SRT analysis. Now, you can trade SRT on its own. It is an entire trading system all by itself. But when you couple it with a system like Tradonics, you're going to have so much more potential to place winning trades. Not just place winning trades, but keep you out of losing trades. Support and resistance. Support and resistance levels are really a gift to traders, and we should be using them extensively. Price on a chart moves in a zigzag motion, and it'll go up and it'll go down. And if price is moving sideways, going up or going down, it'll always be doing it in a zigzag fashion. So no matter how the market is moving, it is going to be up and down, up and down, up and down. Even if it's moving quite strongly in one direction, it's still going to make these little zigzag movements along the way. Now, the points where the market changes direction are the areas that we call support and resistance. Now, what's interesting about these levels is that when price is rejected once at a certain level, it will tend to be rejected there again. Now, this chart is just showing us the different areas of support and resistance. The green boxes are where we have support. Price bottoms out and then moves up. Price bottoms out, moves up, bottoms out, moves up. And the resistance, now this is backwards. I have to fix this before the manual gets out. The resistance is the top parts. We have price moves up and then drops down, moves up and drops down, moves up and drops down. Now, the image below is the same image that we just saw, the previous image on the previous page, but the red horizontal line shows us areas where price is affected and gets turned around. Now, this level is an area that rejects the price several times. This becomes a strong level of support and resistance. See, right where this red line is, price comes up, gets turned away, comes up, gets turned away, breaks through, comes back to that same level, gets turned away. Couple more times, gets back to that same level, gets turned away, breaks through, and then again visits that level and then gets turned away. We have a strong level of support and resistance here. Now, there's three things that we can learn from this simple example. If we take a look at this chart, we can actually take away three different things from this. The first thing is price will be attracted to a previous level of support or resistance. It will be drawn to it. It'll want to move towards that level. The next thing is price will be rejected from these levels of support and resistance. Once it gets there, it'll be turned away. And then the third thing is when price does break through a level of support or resistance, it will have a tendency to keep going. So if I go back to this chart, once we get the price drawn to the level, it can get pushed away. And then once it breaks through the level, chances are it'll keep going. It'll not just sort of move a little bit past it, but if it's a nice clean break and it does get through this level, it will have the momentum to keep moving forward. Again, it gets drawn back to the level and gets pushed away. And when it does break through the level, it will have a tendency or the momentum to keep going. It needs some momentum to push through that wall. And then once it does, its forward momentum will generally keep it going. So specifically now, we're going to look at support. Support is a term from the old floor trader days. Now, this was when you could only make money in a rising market. You've heard the terms buy low and sell high. Support is a level where price drops to and gets turned back up. It will come down and then be supported as though it's hitting an invisible floor. Now, this is where the market is being supported from losing any further value. Generally, the support levels you can see on a chart will be V-shaped. This makes them easy to identify. Now, they're not always V-shaped, but generally they are. They make a move down and then a move up, move down and then a move up. They hit the floor and then bounce up like a ball. Areas of support will be underneath the chart. Now, there are major support levels and there's minor support levels. The major levels are the ones that really jump out at you from the chart, but there are more subtle levels that are acting also as support. The major ones, easy to identify, just big V-shaped floors. They just come down and go back up. But the minor levels are a little more subtle. They're in there, but they're within the zigzag formation. Price comes up, comes down, and then keeps moving up. We get this little minor area of support. It's not really, doesn't jump out at you. It's kind of within the workings of a bigger movement. But we do have major and minor, and the minor ones at times are going to be quite important. So below is the same chart, but it's got a bold red line to show you how the market moves. Now, the small yellow arrows are all the different points where the market hits that imaginary floor. So we can see this, the red line in here essentially just shows you that there is quite a zigzag movement to the market. If we're looking at the market this way, you can tell that there's a zigzag to it, but it's not quite as clear as if you were to highlight the highs and lows. The market came to the bottom, moved way up to the top, came way back down, way up, down. With the line on the chart, you can really see that zigzag formation that the market does make. Every time it zigzags, we're creating a level of support and a level of resistance. Now, this chart, we can see these areas of support and the areas of support on a Tradeonics chart. Now, the additional indicators can make it a little harder to see, but once you look for them, they're going to start jumping out at you. The additional indicators, that's the TB cloud, the arrows, for example, they're going to sometimes hide some of these areas. But if you know what it is you're looking for, they're not going to be hard to find. You're going to see them fairly clearly once you know what it is you're looking for. Area of support, got a floor, another floor, another floor. These are the major areas of support. And you can see within, we've got some more minor areas that we can fairly easily identify. Now, the TBS forms its own visible levels of support. Now, they are derived from the price, but might be easier to see for a newer trader. When the TBS pulls back to form a low or starts a new line, we have an area of support. Now, the TBS is going to move up. It's the solid line within the chart, within this cloud here. So as the price pulls back, the TBS is also going to reflect that pullback. It's going to also move back. And this gives us maybe an easier way to see or identify these areas of support or resistance by looking at how the TBS moves. The TBS is going to cross sides. It's going to go from red to green. And then once it turns back to green, where it starts, where the green TBS starts, could also be considered an area of support. So this is the opposite. We're going to look at resistance. Resistance. Now, this is also a term from the old floor trader days. Now, resistance is when the price climbs up and hits a ceiling and resists moving any further. The older stock traders would view this as the market being resistant to further gains. Now, on a chart, resistance levels will look like peaks of a mountain or upside down V's. Like support levels, there are major and minor resistance levels. The major levels will be the peaks that stand alone, very easy to identify. They're very distinct and individual looking. The minor levels will be a little more subtle. Again, it's the same scenario. We get the peaks that move up, market moves up, and we get these major levels because they're very distinctive. The minor levels, they are kind of within the market movement. They're a little more subtle, but they're still there. We still have these little areas where price moves up, comes back down, moves up, gets rejected, comes back down. We can see the areas of resistance on the Tradonics charts. They are clear and easy to spot after you know what it is you're looking for, after you can identify it. It's just like anything with trading. Once you understand what it is you're looking at, they are not hard to see. We've got resistance, price comes up, hits the ceiling, hits the ceiling, hits the ceiling. And they become fairly clear, fairly easy to identify. So below, we have the same areas of resistance, but this time we're using them on the TBS. These levels are where the TBS starts or forms a high. So we either have a start, a beginning where the TBS turns from green to red. Now this would be considered an area of resistance. And also we have these little movements, just like the green one. We've got the red one where price pulls up, but the TBS doesn't switch sides. So we get this little peak, this little mountain within the TBS. And this could also be viewed as an area of resistance. Again, this is another way to look at this. So this is a line chart graphic of support and resistance levels. The line chart representation might be easier to look at and understand. See, I'm really trying to make sure that this is understood. I'm going to give you a few different ways to look at this so that it is something that you understand. The red peaks are areas of resistance. Price moves up, gets turned down. Price moves down, gets turned up. These are areas of support. So we can see support and resistance on this very simplified version of a chart. Again, without the areas, without the clutter, we're taking a look at areas of support and resistance. Hopefully they're quite easy to identify now. Support becomes resistance. This is very cool, and I use this a lot. When price breaks through one of these support or resistance levels, we often see price come back to test this level. When price finds a level of support, once it breaks below it, it will often come back up to meet this level now as resistance. Price forms support. It bounces off the floor and then drops back through it. Doesn't bounce this time. It gets through that level. It breaks through support. But once it's below it, it comes back to test it from underneath. Once it does that, it becomes resistance. This happens a lot. We're going to see this a lot on our charts. This, for me, is one of the best ways to validate a trade. You're going to see on this chart, this is a real life chart example of support turning into resistance. Price finds a floor, gets rejected off the floor, breaks through the floor, and then comes back to test that level as resistance. So support turns resistance. Now this is the same on a real Tradeonics chart. We have support. We have two levels of support. Price finally breaks through and then uses that exact same level as resistance. Price forms another low, another support level. Price breaks through it and uses that as resistance. We even have an instance right here where it came back to test that as resistance. Price breaks through, comes back. And I could draw another line right here. This support, if I draw a line straight through, we would have this area here being used as resistance. Price makes a support, comes down, breaks through it, and then pops back up to use it as resistance. This happens regularly. Again, another chart example of the same thing. We're going to see this on our charts all the time. Support, breaks through, comes back and tests that area as resistance. Makes another low, support, breaks through it, comes back to test it as resistance. And again, we can look at that down here in the lower right corner. Forms support, and then price in this area here can't get above it. It's using it now as resistance. What time frames do I use this for, Dean? This works on every single time frame, right from the 1 minute to the daily, the weekly, the monthly. All right, so we're going to look at the opposite now, resistance becoming support. That is just the image flipped upside down. So we have, we'll read the text here. The opposite is also true. When the price finds a level of resistance, it may eventually break through and then turn around to use that same level as support. Price moves up, finds itself some resistance and gets rejected. This establishes a level of resistance. Price will break through it. It'll move up towards it. Remember, it's drawn to that level. It'll be drawn to that level and then break right through it and then turn around and use that previous level of resistance as support. This is an example of resistance turning into support on a real chart. And we have resistance, price breaks through it, and then uses that same level a couple of different times as support. Now this is the same thing on a Tradeonics chart. This is what it looks like when we see resistance turn into support on a Tradeonics indicator-laden chart. Resistance, price moves up, finds a spot where it can't break through, gets turned away. Finally, it does break through and then comes back to test that level as support. And then from there, we have a nice trade. These often will trigger some of the finest trades, some of the nicest trades. When I see trades in the forum that use this, traders don't often know that's what's going on, but I'd try to point it out. This is the trade. I've taken pictures of the chart that they posted and drew a line through and said, this is why this was a nice trade. This level of resistance turned into support. Price bounced off of that. That makes it that much stronger. Another example. We've got resistance, resistance, resistance. Finally, it breaks through and then comes back to test that level as support. Now, we've got a couple of different tests, but when we get a trade that takes off of this, the market does move quite well. It moves quite nice off of that level. Now, support and resistance are areas. This is a big thing. They're not exact prices. They're areas. Areas of support and resistance are called areas on purpose. They're quite often not going to be an exact price. Price will use a certain level as a level of support and or resistance, but it will be an area. Now, there is a halo effect around these levels, and price will touch the level exactly. It will not quite get to the level, or it will push past the level just a little bit. The areas of support and resistance form more of a support and resistance zone. price can get into the zone or touch the edges of the zone. And all the while, the average of all these levels will be the valid area of support and resistance. So you've got the highs and the lows. You've got this kind of window that price will get through, just above and just below the average of that. When I draw these areas on the chart, that's what I'm looking for, is the average. This is a low, this is a little bit higher, this is a little bit higher, this is a little bit lower, and I'll place my area of support and resistance, that line, that horizontal line, kind of right in between all of that. And that gives me a nice area, this nice average zone. So price comes up, touches exactly, overshoots it just a little bit, may not quite get to it, overshoots it just a little bit from the other side. Even though it overshoots it or doesn't quite get to it, that area is still acting as support and resistance. There's so much in the market, momentum-wise, that stopping on a dime is difficult to do. It can do it, but it's often quite difficult for that to be the case. So we have to give the market that little bit of a window. Now, this is a live chart example of what we would consider a strong level of support and resistance. Now, looking at this, I should have included a chart without this line. When you see a chart like this without the line, it is not so clear if you're not very sure what it is you're looking at. Once you put that line in here, though, you can really see how this acts as a strong level of support and resistance. Price just about gets to it. It overshoots it just a little bit. It gets to it exactly. It overshoots it a bit. Doesn't quite get to it here. Overshoots it just a little bit. It gets to it exactly here. Not quite here. Not quite here. Gets to it exactly here. But we have, through this, a bit of a halo effect. We've got this, just that little window, but that line is a nice average of that. So when price starts to approach this line, we want to take note. Now, this is the same chart, the same line. This one has the halo around it. So we can see price is getting into the halo, gets into it, hits the top of it, gets to the bottom of it, gets inside of it. You know, this halo becomes the window that you would like to refer to. When price starts coming up from underneath and gets to kind of the outside of that window, then we can start looking for it to get rejected. But I wouldn't assume it's going to get rejected right there. It could get all the way to the top of that halo before it gets rejected. You know, same from the upside. It comes down. It could get rejected at the top of this halo, or it may get rejected in the middle where the actual level is, or it might get rejected at the bottom of it. So we have a window that we want to pay attention to, not to the exact line, but we want to give it a little bit of play. There's a little bit of give and take in there. We can use support and resistance as stop losses. Now, this might be the oldest play in the book, and the reason we still use it is because it works. Now, you will have heard that your stop goes above the recent swing high, or place your stop under the recent swing low. I use this all the time. I'm always mentioning this. That's what this refers to. Placing your stop loss at the most recent level of support and resistance. Swing high, swing low. These are where the market turns. In the example below of a buy trade, we place our stop loss just below the most recent level of support. Now, not on the level, but just a few pips below the level. Again, we want to take into consideration that halo effect. We want to have the level is right where the price stops. So we want to give it that halo. We want to put our stop loss in a more safe place. We want to get it just below that potential halo that could be there. And this is referred to as a swing. We have a swing low because the market changes. It's a very definite change in direction. When the market's moving sideways, there's no real swings. It's just kind of a sideways bobble. When we have the market rise up and then come down, we've got a swing high. Comes down and moves up, we've got a swing low. Stop loss will get placed under it, plus the halo size. And that's not written in stone what that size is going to be. I go for more of a visual look when I place my stop loss underneath. I don't want it too far away. I don't want it right on, but I want it away. I want it kind of what we've got in this image here. That for me is nice. That I know I'm going to get asked how many pips is that. That is going to change from chart to chart, from time frame to time frame, sorry. 1 minute, it might be 1 pip. A 1 hour, it might be 5 pips. A 4 hour, it could be 20 pips. In the example of a sell trade, we would place our stop loss a few pips above the most recent swing high or the most recent level of resistance. Again, not on the level of resistance, but a few pips above it. Again, that accompanies that halo that we were looking at, that halo effect, that zone. The reason we do it this way, I'm just going to touch on that because it's not in the manual. The reason we do it this way is the definition of a trend. And that's essentially what we're doing is we're trading a trend. The definition of, let's go to this one here. The definition of an uptrend is a market making progressively higher lows and higher highs. That means we've got a low followed by a higher low, followed by a higher low, followed by a higher low. We have the definition of an uptrend. When you place your stop loss below the swing low, if the trend really is a trend and it's intact, the market is going to pull back. It's going to come towards your stop loss, but it shouldn't get as low as that previous low. That is essentially the definition of an uptrend. Same thing with a downtrend. You have a downtrend. The definition is a market that is making highs followed by lower highs, followed by lower highs, and also making lower lows, lower lows, lower lows. So we've got a high followed by a lower high, followed by a lower high, again a lower high, a lower high. And same with the lows. They're getting progressively lower and lower. Placing your stop loss above the swings as they happen in a trend is the safest place to do it. Support and resistance as targets. This is a good one to know too. I use this one quite regularly as well. Using a 1-to-1 is awesome. Using a 2-to-1, it's great. But knowing where the support and resistance levels when you're placing your targets may get you a little bit more than 1-to-1, and it may alert you to the fact that a 2-to-1 might be a little bit too much. It might be a little bit too far. Just like we can use support and resistance levels to find a trade or decide not to take a trade or place a stop loss, we can also use them to find suitable targets for our trading. Remember, support and resistance levels act as a kind of magnet to the market, so they will draw the price towards them. We get a signal to go short. This is our short signal. So now we are short. This is going to be a Tradonic short. We're going to be looking for a target. Now we can place a 1-to-1, but in this case, we're going for support and resistance. This becomes our level of support. Text. Let's read the text. We found our area of support. Support and resistance levels are areas, so we want to target the side closest to the entry, which would be the area just above the level itself. So if this is the level of support we're looking at, we don't want to place a target on that level. We want to, again, we're going to mess with this halo. We want to put the target just above that level so that if the price can't get to that level of support, that at least it gets to the top of the halo, we're still going to be taken out of the trade and profit. All right, in this case, it blew through, but that's how it goes. Target's easily hit, and I'm just going to point this out. We have this area of support, which turned into resistance, which turned into resistance, which also turned into resistance. We find this everywhere. If I draw a line across here, we see an area of resistance, resistance, resistance. Support resistance is a wonderful thing. Another chart, we find our entries. Our targets will be a recent level of resistance. Price will be drawn or attracted to these levels, drawn as in move towards. So they make excellent take profit levels. Again, we have an uptrend. We've got lows, we've got lows followed by higher lows, followed by higher lows, which means the highs ideally are going to be progressively higher and higher. So we've got a Tradonics long signal here. Where would be a good place to place a target? Well, I would like to aim for this swing high. Again, not on the swing high. I want to take into account that halo effect. So I'm going to go just below it. Boom, we get a nice trade out of this. again, we get the market moves up, forms a swing high. We get a tradonic signal here where would be a nice target. We could go for a 1-to-1. A 1-to-1 would put us in here. Maybe there's a little bit more room for this area of resistance. So we'll target the area of resistance and we get that hit, no problem. These areas of support and resistance are really nice for our targets because the market is going to be drawn towards these levels. Just excuse me 1 second. Sorry about that. I got to drink every once in a while. Trend lines. This one also a big deal. Trend lines are simple, diagonal, or angled areas of support and resistance. Trend lines are used when the market is moving either up or down. They can be used over a large period of time, many candles, or they can be used over a shorter period of time with fewer candles. Implementing them in the tradonic system, I use trend lines over a shorter period of time with fewer candles. And this gives me much more relevant areas of support or resistance that I can base the trade decision on. In order to draw a trend line, we will need 2 points of reference. Now, we will be connecting either 2 highs or 2 lows that the market has made. The ideal trend lines for this system are drawn when we have 2 consecutive highs or 2 consecutive lows. And this means one right after the other. When you're connecting the lows, you want the lows to be getting progressively higher. And when you're connecting the highs, you want the highs to be getting progressively lower. All right. In order to use a trend line to facilitate a trade, the price will need to close past the trend line in the desirable direction. Since trend lines are indeed areas of support and resistance, the price will have a strong tendency to bounce off a trend line. Now, with this being the case, we want to see the price close past the trend line to confirm a move in the proper direction. Trend lines are often counter trend in nature. Price is moving down, we're going to draw a trend line across the top. When price crosses the trend line upwards, it will have a tendency to want to keep moving up. All right, so bullish trend lines. We want to connect 2 consecutive highs in a downward moving market. So when I say a downward moving market, all I mean by this is that we want to see one high followed by a second high that is lower than the first. So things are just moving downwards, staircase stepping down. This can occur in an uptrend or a downtrend. All we are looking for is a high followed by a lower high. Price makes a high followed by a lower high. This is step 1. These 2 points are connected and the trend line is projected ahead of the price. Price pulls back to the trend line. At this point, price could possibly bounce off the trend line, or price can break through the trend line, suggesting a move upwards. And this is a graphical representation of that. It's a high followed by a lower high. And we have that in image number 1. We've got a high followed by a lower high. We connect these two and draw a line that connects them and just shoot it off into the future. From there, we see a bounce or a break through the trend line. So price comes up to the trend line level. So we've got our trend line drawn and it's projected into the future. So we have price coming up to the trend line. From there, we have 2 different things that can happen. Price can bounce off of it and continue to move down. This is an angled area of support and resistance. In this case, it's resistance. So a bounce off the trend line is very possible. Or if that doesn't happen, we don't get the bounce off the trend line, it will break through the trend line and continue to move upwards. Below, we see an image of a bullish trend line. Now, it's called a bullish trend line because when it breaks through the trend line, the market is going to rise. We see an image of a bullish trend line on a Tradonics chart. Now, there are 3 points of contact in this case. Generally, we only see 2. But the more points we have, the bigger the breakout can potentially be. Now, we can get more than 3 points. Here we have 0.1, 0.2, 0.3, and they all form a line. They all line up very nicely, and we can connect them to draw a trend line, and then we project it kind of into the future. Price does close above the trend line. So at this point, we're going to start looking for an opportunity to go long. We're going to start looking for a reason to buy. Now, this is, again, it's not something that I mentioned in the manual, and I should have. Trend lines are areas of support and resistance, and they do have the same characteristics as a horizontal level. And in this case, I hope the arrow is not hiding it too much. But what happens is price breaks through it and comes back to test that line, to test that trend line. This happens fairly regularly. We will get a close past the trend line, and it will come back to test the trend line before it takes off. This is not always the case, but it does happen enough that we want to make note of that. All right. Here's another example of a bullish trend line on a Tradeonics chart. So we've got point 1, point 2, and then the close above, and then the move up. This is what I refer to as the ultimate trade signal. I love this one. I look for this one and I love it to death. This one is a bullish trend line in an upward market. And we've got two examples of that here where the trend is up. Now looking at this, the TBL will be green throughout this. We have a green TBL. The overall trend direction is up, but I have a downward moving trend line. Trend direction is up. I have a downward moving trend line. When I get a signal in an uptrend where I can draw a down trend line, I almost always will go for 2 to 1. I want the market to move on this because this setup is powerful. This is consolidation. This is market making its move and then getting tight. And it's starting to tighten up. And then from there, generally, we see an explosion. It's like a little bomb, nice tightly packed bomb that just bang. And we see that a lot. Of course, like anything with trading, it's not 100%, but it happens enough that I will place my 2 to 1s. If my area of support, or in this case resistance, is close to 2 to 1, I'm there. I'm looking for that. The ultimate trade setup. After the PowerPoint, I'm going to show you a couple examples on charts of this. But for me, this down trend line in an up market is one of the nicest signals that I could look for. All right, bearish trend line. We want to connect 2 consecutive lows in an upward moving market. So when I say an upward moving market, again, all I mean by that is that I want to see one low followed by a second low that is higher than the first. So we have lows followed by higher lows, definition of an uptrend. This can occur in an uptrend or a downtrend. All we are looking for is a low followed by a higher low. Again, the steps: a price makes a low followed by a higher low. These 2 points are connected and the trend line is projected ahead of the price. That means we just sort of drag it out, just make that projection. Price pulls back to the trend line. At this point, price could possibly bounce off the trend line, or price can break through the trend line, suggesting a move downward. Again, the graphical representation: a low followed by a higher low. So this is the area here that we're looking to quote unquote an upward moving market. So we've got, this could be a downtrend. We could have the price starting here, moving down here. But this section, we've got a low followed by a higher low. We can draw the trend line that connects them underneath, and off it goes. When you are drawing your trend lines, I want to make this point while I'm thinking about it. You want to draw them as though they are a springboard, as a wall, as something that the price will bounce off of. When traders are unfamiliar with drawing a trend line, they're not quite sure what side the trend line gets drawn on, top or the bottom, because it's different. When the market is moving, in this case, upwards, we've got a low followed by higher low. You want to draw the trend line as though the price is bouncing off of it. So it'll go bounce off the bottom, bounce off the bottom. And then in a downward moving market, you want to draw the trend line across the top so the price can bounce off of it. Hits the ceiling, bounces down, hits the ceiling, bounces down. You get used to this with a little bit of practice. On a downward moving market, the trend line is drawn across the top. On an upward moving market, it's drawn across the bottom, because that is how the price bounces off of that level. All right, so step 1, we have 2 points, a low followed by a higher low, and we get to draw the trend line. We connect the 2 points and we just project that out into the future because we know that the price is eventually going to come back to that line. Step number 2, price does come back to that line and it comes to that trend line. It meets the trend line. From there, we have 2 options. What is going to happen? This is where we sit on the edge of our seat and we stare and we watch what's going to happen. Price can bounce off the trend line and continue to move in the trend direction. That's a strong possibility. The other possibility is price is going to break through it. It's going to break below it. And then if it does this, it can continue to move down. Once the price closes below the trend line, we get the confirmation that the short trade we're looking for is a good trade. Now, this is another example of what I would consider an ultimate trade setup. We've got from in here, down here, the trend is starting to move down, but I'm able to draw a trend line, an upward trend line in a down market. So I've got a low, I've got a higher low. I can connect the 2 underneath, and then price closes below. This, for me, again, the ultimate trade setup means I'm going to be able to go for 2 to 1 on this. Again, not always is it going to give you 2 to 1, but the probability is quite high that you're going to get 2 to 1. So I'm going to take advantage of that. I like this setup. I like this scenario. I like how it works out. I like the math behind it. I like the psychology behind it. Once it breaks below, it can move quite a ways. So we get the break or the close. When I say we get a break below, price can poke through it and then not close below it. That technically is a break, but what I'm looking for is the price or the candle to get through it and then close on the other side of it. Once we get a close on the other side, there's enough momentum there for me to want to keep moving forward. I'm going to take the trade, and it's going to line up with a tradonic signal in this case. A second image of the tradonic system in regards to the bearish trend line. Now, this is in a period of some chaos. We had this nice big move. This is an odd chart because it's such a beautiful chart. The market is moving fairly smooth. It's not one that I want to stay away from until we see this, but then it smooths itself out right away. And even in this example, the trend line still functions. It still does what it does. We have a low followed by a higher low. We're able to draw the trend line. Now price from there could just keep moving up. It may never even come back to the trend line. It did. It came back to the trend line. At this point, we're interested. What is going to happen? We're going to get a move back up. We're going to get a break below or a close below. We get the close below and the market really does drop. We get this nice 2 to 1. This is in a down market. The TBL in this case would show us red. We have a down market. So we are looking for the ultimate trade setup in this particular case. We have an up trend line in a down trending market. This gives me 2 to 1. Beautiful. Now, this is the SRT assessment. Let's just get into that one. SRT is an acronym for support, resistance, trend lines. It also happens to be the kind of car I drive. For those that own Dodges, you'll know what I mean. The SRT method combines both support and resistance levels with trend lines. It's a simple process, and I will show you how it works. When we're considering a trade, we want to evaluate the levels that could get in the way of our trade or help the market move. The long SRT evaluation. We consider a recent level of resistance. All right, so we're going to find that level of resistance. If price closes above this level of resistance, we can consider taking the long trade. This is very simple. This is simple resistance at this point. We get our resistance, price comes up to visit it, and then at this point, we get the close past it. We are good for a long trade, right? Now, if we don't get a move above the first level of resistance, but instead makes a lower high, then we draw a trend line connecting the falling highs. Once price closes above the trend line, we can consider taking a long trade. So this becomes that first level of resistance. What we're looking for is a price to come back to it. We don't get that. The price doesn't come back to that level of resistance. Instead, it makes another high. It keeps zigzagging its way down. So it makes a high, and then it makes a lower high. So it never gets to that level. So instead of this level of resistance being what we're paying attention to now, we can draw a trend line instead. So now that's the point of interest, is the trend line. We're going to draw the trend line, and from there, it's the trend line trade that I'm interested in taking. All right? SRT short SRT evaluation. Same thing, just the other way. We consider a recent level of support. If price closes below this level of support, we can consider taking the short trade. Again, price makes a floor, pops up. So we've got that level of support. Price comes back to that floor, breaks through it. We can consider taking a short trade. Simple enough. If we don't get a move below the level of support, but instead makes a higher low, then we draw a trend line connecting the rising lows. Once price closes below the trend line, we can consider taking the short trade. Now, it's the same sort of scenario. We get that initial area of support. We're waiting for the price to come back to that level, but it doesn't happen. We get that zigzag moving upwards. So price makes that low, comes up, starts to get towards that level of support, but it doesn't quite get there. It makes a higher level before it changes direction. So we have a low and we have a higher low. When that's the case, when that happens, I can draw that trend line connecting those two lows. When finally we do get a close below the trend line, we can choose to take the trade. Now, knowing what we know now, what would make for a good target? Well, this level of support would make for a good target on a trade that closes below the trend line. Yeah, it's all coming together. Support and resistance and ranges. Now, this is a good way to stay out of trades. We use levels of support and resistance to establish or define tighter ranges that we don't want to trade. The market experiences periods of time when it is very flat and moving sideways more than up and down. This can happen after a larger market move and when the market needs to rest, or we'll see it during the off hours, namely during the last half of New York or the Asian session for most pairs. We can find a level of resistance above the range and a level of support under the range and use this information as a no trade zone. So once price gets itself into a range, it will continue to range until it moves outside of the range boundaries. And this goes back to that thing that I say all the time, the market's going to keep doing what it does until it stops. Below you see a sideways market that occurs after a large market move. Now the market goes very quiet and moves sideways. So we get this big move, we get the bounce after the big move, and then from there, this formation is typical of a large move, generally after a session. We get this big move, we get the bounce off the floor as traders are closing out their positions. We have that move as a result from that, and then from there, not a lot of market activity happens simply because there's just not a lot of exchange going on. There's no give and take, not a lot happening. So what we get is a sideways market. We need a lot of market transactions in order to make the currency rate change. After a lot of these sessions, after a big move, we get this period of contentment. Buyers and sellers have slowed down for a little bit, so that exchange isn't happening. After sessions, like after the London session, this is what we're typically going to see is the London session will end. We will get our sellers buying back their positions or closing their trades, and we get that effect from it. This little spike upwards, this little jump is an effect from mass closing. So what happens is we get that, and then at that point, not a lot happens. So we get that settling effect, and the market just kind of wanders. There's no momentum, but it will move up and down, and it'll move, but just without any oomph to it. Like there's no momentum behind it. There's no real drive to move in any one direction. And we get that kind of market. Now, trading in a market that is doing that is not often going to end very well. We are not going to get a lot out of this. Could be a 10 pip range. Going for a 20 pip target in a market that is only moving 10 pips is not going to work out very well. When the market is moving sideways, I want to let it do that. All right, so a level of resistance can be drawn across the top, and a level of support can be drawn across the bottom. Once we see that there is a range forming, we can draw our levels of support and resistance to define the no trade zone. We know that the market is going to aimlessly wander within this zone. It's made its high, it's made its lows, and the market is just going to kind of bobble throughout that. Once the range is established, and we don't want to trade it until the market moves outside of the range. Again, you're just going to get more of what the market's been doing. So if I've got the range marked out, I'm essentially marking out this is where I don't want to trade until I see that it stops doing what it's doing. Finally, the market breaks out of the range. And as you can see by the example below, that when the market breaks out of the range, it will continue to move in that direction. Not always, but frequently. So once we get a breakout out of the range, what we have is, I'm going to go back to that saying, the market's going to keep doing what it's doing until it stops. It was ranging and it kept ranging until it stopped. It broke out. It broke out of that range. It's not ranging anymore. So now we are looking for our trades. Again, I'm going to bring me right back to this. We've got a level of resistance, price breaks out and then uses that level as support and then pops up. Even in chart examples that were not intended for such things, you can see those examples over and over again. Many traders like to trade the breakout candle, and there's nothing wrong with that. But to avoid a false breakout, I like to wait for a pullback and trade that. In the case of Tradonics, we'd be looking to trade either an aggressive or conservative setup. So there are going to be times where a trader is going to trade this candle here. Now, you can do that. That's a trading methodology all on its own. What I'd like, though, is generally for that pullback to happen and then the signal. That is how a trend trader generally trades. We get an example here of the false breakout and then the move right back in. So if we had taken this trade, it would have been a loss. Again, we would wait for a pullback and then the signal to go short. We get the breakout, in this case, to the downside, and then off it goes. Support and resistance and trend line bounces. So this is a bounce off support and resistance. This is a bounce off of trend lines. And we had essentially covered this. We're just going to look at it one more time. Up until now, we looked at support and resistance and trend lines, mainly for their ability to break through and give us a trading signal. These levels also work really nicely as trading opportunities as the price bounces off them. This is done by most traders as support turns into resistance or resistance turns into support. Traders will actually look for these opportunities. Bounces off support and resistance provides good confirmation of a trade signal. So we've got potentially a long trade in here. We have price making a floor and then bouncing off of that floor as support. We get a signal to go long. This becomes a favorable signal. This becomes a signal that I would get excited about because it is bouncing off of an established floor. And the same thing with the short trade. Potentially we could have a short trade in here. Price comes up, makes a high, comes back to it. It's attracted to that level and then bounces off of that high. And then at this point, this short trade becomes a very favorable opportunity. We have extra confirmation, extra validation that the signal we're taking is a good signal. That's a question that I want traders to ask themselves. Why is this a good trade? When you see a setup like this, I mean, you've got the system signal. Of course, that's going to carry some weight. But why? What else can I add to that? What else is going to make this a good trade? I've got the signal from the system, and I also have validation or confirmation as price is bouncing off of a level of established resistance or established support. That would make for a good trade. Now, I'm eyeballing this, and I can see if I connect 1, 2, 3, 4, I can draw a trend line through here. And what happens is price breaks through and it would come back to the trend line. If I were to take a long trade in here, that would be a good reason to take the trade. That's not marked on the chart. You don't have to see what I'm seeing. I'm just kind of eyeballing what I'm seeing here. If you can imagine connecting these highs with the trend line, you see that we get a bounce off of that trend line here. Again, we're seeing these examples in charts that are not built for these examples, but they're there. They're there all over the place. Now, an upward trend line gives us opportunities to buy when price bounces off of it. So we have the first 2 points, point 1, point 2, they're circled in green. This is what establishes the trend line. So we've got these 2 points. When the market, all of this market wasn't there, we've got the 2 points. We draw this trend line out into the future. And then we get the bounces off the trend line, comes back to the trend line. And then if we get a signal in here, this becomes a favorable signal because it's bouncing off the trend line. Same thing with this area. Bounces off the trend line, becomes a favorable signal to go long because we have that bounce off of an established trend line. A downward trend line gives us plenty of chances to sell as price bounces off of that too. This trend line provides us with areas of angled resistance, and that's all a trend line is support and resistance at an angle. So these circles, we have point 1, point 2. This is going to give us those first 2 that give us the trend line. So from there, we can draw the trend line. And then we have another bounce off the trend line, a bounce off the trend line, a bounce off the trend line, a bounce off the trend line. It's happened 1, 2, 3, 4 times after that established trend line. When we get a bounce off a trend line, this is also important. That halo effect with trend lines still counts. It's still in play. It's still present. It's going to be there. We can get a bounce off of a trend line when the price doesn't quite reach the trend line. We can get a bounce off of a trend line when price crosses the trend line a little bit and turns around and comes back. What we're looking for is the direction we want to trade. What's the direction we're looking to trade? If we're looking to trade short in here, and we get a close above the trend line and then a move back down below the trend line, that validates the short. It doesn't need to bounce directly off of it. It should get close, either a little bit above, a little bit below. Again, this is something that's going to need a little bit of practice. Trend lines, I find, don't have as much wiggle room as horizontal levels. When you have a trend line, price tends to bounce off the trend lines better than horizontal levels of support and resistance. Of course, we're going to find examples where that's not the case, but over my time, this is usually how it works. Now, again, I'm going to bring this point up. This chart wasn't made for it, but sure enough, we get a close above the trend line, and then price pulls back to the trend line and then takes off. So that support or resistance becomes support applies in this case too, on a chart that wasn't built for it. That's awesome. I love trend lines. Support, resistance, and trend lines are incredibly powerful tools, and we are able to use them on a regular basis. They will help us take a trade. They will help us stay out of a trade. They will help us find a target for a trade and where to place a stop loss. Now, use them in your trading each time you trade. They are great tools for market assessment, and they will help you be more profitable. The end. So that is the PowerPoint. So I'm going to a couple of questions. Is this considered a counter trend? It is going to be considered counter trend in nature for a lot of this. And this is a webinar for this, so I don't know how much I can get into something else, but the next webinar, maybe the next webinar, we're going to be focusing specifically on counter trend trades. We want to trade in the direction of the trend, but we have ways to trade in the opposite direction. And this is going to lend itself very, very well. So in the webinar that we do discuss counter trend trades, trend lines are going to come up, and you'll know about this because of what we've covered today. So the trend lines will come up. We're going to introduce other aspects to counter trend trading. Trend lines, support and resistance, they are going to be important features to this. This is a huge deal. Like trend lines and support and resistance are, I mentioned it earlier, it is the way the old school traders traded. There was volume, and then there were trend lines. A lot of the really big guys back in the day would place their target or place entry orders only on support and resistance levels. And then they would sit and they would wait for days or weeks sometimes for that level to get touched so that they would be entered into a trade. It works because it's being worked, if that makes sense. They work because traders pay attention to them. It works because that's where markets, funds, banks take their profit. It works because that's where they get into trades. They work because so many other traders are looking for these levels. There is an element of what they call self-fulfilling prophecy, because we say it works and we learn it works, and it does work because that's how traders are trading them. It works because they're being worked. I want to show you a couple of examples here. I've got a few that I've marked off. This is, again, the ultimate trade setup for me is when I can get an uptrend. And we've got the TBL is green in this case, and then I can draw a down trend line. If I can get an uptrend and draw a down trend line, this is going to give me, this is a conservative long, this one right here. This is a conservative long, this one right here. So they give me two really nice signals. Now we have aggressive signals in here. Well, because the trend line, there we go. Because the trend line is formed, we get 0.1 and 0.2, and we have aggressive signals in here that do not close above the trend line. This would keep me from taking a trade. You can take a trade. That's the whole thing with this aggressive entry signal, is it is very aggressive. It has to be understood. It's aggressive. It's called aggressive because of its aggressive nature. We don't have all the confirmation that the market is going that way. We've got some leaning towards it. We have markets saying, I'm pretty sure I'm going to go that way, but the whole picture is not complete yet. This is going to help. Now, if we can get a trend line that we can draw like this and get a close above a trend line and still have an aggressive signal on the tetragram, I'm down with that. I'm good with that. I can go for that all day long. Let's see, do we have any other examples? We've got a couple here. This is a ultimate trade setup in an uptrend. So we've got the market moving up, or yeah, the TBL is up throughout. This one's kind of neat. Draw a downtrend line in an up market. Now, Robin, I think it was you that actually did this one the other day. And you took this trade, and this was, and I even explained on a chart, I drew this on your chart, that I said, this is why I really like the trade that you took here. And this was why I'm able to draw a down trend line in an up market. And this became a beautiful signal for me. Like, this was awesome. There's a couple of different things here. If I can do this as well, I'll draw I have an area of support, another area of support. This didn't quite get to it, almost did. Still counts because we have that halo effect, remember? So we've got price bouncing off of support. We've got this down trend line in an up market. And then we get the close above that. Everything about this trade is beautiful. We have such a nice, elegant setup. And as a result, the market did take off. We have an upward trend line in a down market. Now this one, during this phase here, because it's a little bit sideways, the TBL did change sides a couple times. When we did get the signal though, we had a short. Now this wasn't even a conservative. This was the next one. This was the conservative short, but it didn't close below the trend line. So at that point, you want to make that evaluation. That's a conservative short. It is above the trend line. Can I take it? Yes, you can take it. But you have to be willing to accept that it might bounce off of the trend line. Price may bounce off of the trend line. If we get that signal on this candle here, it's conservative. We get the big tetragram bar. Nothing's in the way except for the trend line. This may prevent the market from moving past the trend line. We could have a conservative short trade that doesn't go anywhere. As a result, though, we get the next one. This becomes the trade of choice. And then from there, the market did drop fairly nice. So we got, at this point, it was the downtrend. The market started moving down. We've got the TBL is red, and it's an upward trend line. Even though there was a little bit of TBL adjustment back and forth in here, at the time of the trade, the trend was down. The trend line was up. I, again, would consider this to be the ultimate trade signal. Now, like everything in trading, nothing's 100%. This is not going to work out all the time. It's not always going to give you a 2-to-1 ratio, but it gives me that ratio enough that I'm willing to take it. I'm willing to do that. We have another example. This is an example of one. It was a nice one. It just didn't go super far. Now, why didn't it go really far? Because the time of day. This generally wouldn't even be a trade I'd want to consider taking because of the time of day. We've got the close of London right in here. This one was one choppy market. It got a lot of just up and down. Look at the size of these candles. We had some big candle moving up from tip to tip. 30 pips on one 15-minute candle. This is the Euro USD. Now, it's not prone to huge market movement like that. And then it moved down 30 pips. Then it moved up 40 pips. So that kind of chaos makes me want to stay away from a market like that. I was able to draw a trend line, though. And as a result, we could draw a down trend line in an up market. The close above that trend line moved the market. This was a winning trade no matter how you slice it, because our entry would have been here. If we had trailed the stop loss, the TBM would have been in profit anyways. So in a bad market, inside of a range, like we've got this swing high, we've got this swing low, and the market never got out of that range for a long time. There was still some money to be made there. We were able to take a long trade based on the trend line, a down trend line in an up market. Edwin, is the SRT more reliable on the 1 hour than the 5 minute? I don't think so. I think with the 5 minute, with the 5 and the 15 minute, you always have to assume, or I always have to consider the time of day that you're trading. Right? You always have to consider what time it is. If you're trading the off hours, and that essentially for a lot of currency pairs is the end of London through Asia. The Asian pairs, like the Australian dollar, the yens, and the New Zealand dollars, they can move during Asia. This one's a Euro USD, and it's fairly flat. It's fairly quiet. Even though the market does move, it doesn't have the momentum behind to really kind of push it anywhere. So you'd want to stay away from that. You want to at least pay attention to that when you are trading the small time frames, 5, 15 minute. Be very aware of what time of day you're trading. That end of London through Asia can be very, very quiet. Not always. Sometimes it moves. Sometimes it surprises me like crazy. Like it shouldn't move like this, but it is. Now, that simply happens because of something big that's going on. But generally speaking, they are quiet and they don't move a lot. Is Tradonics considering a lagging indicator? Now, I'm interested in people's concept of lagging indicators as opposed to what? Every indicator, except for news, every indicator has to be based on some previous kind of evaluation. What did the market do to project this? What did the market do in order to project this? Some people will say Fibonacci's are leading indicators. They're only leading because you're getting a projection, but that projection is based entirely on what has happened. You cannot get a projection unless you know what's happening. Now, there's nothing wrong with a lagging indicator. They have to, in order to get some sense of what's going on. You got a trend that's up, you got a trend that's down. How do we know this? Because the market is lagging. If I were to show you one dot, this is the current price on the chart without seeing anything else, how do you know to buy or sell? How do you know how far it will go? How do you know where to place your stop loss? You don't know any of that stuff unless you have the data, that the historical data. And historical data could be like 1 minute ago. But that's how you make the assessment, the evaluations. That's how you know the market is turning. That's how you know there's a trend. That's how you know the stuff that we need to know is that lagging information. And sometimes a short lag with a quick period like the TBS is what we need. Sometimes a very long lag is what we need, like the TBL, 50 periods. Sometimes we need a 200 period lag. It's important because they still carry a lot of weight. With a 200 simple moving average, that becomes a target. The price will be drawn to it. Now it lags by 200 candles. However, price will often reach it. It's not a forecasting indicator because it's based off the last 200 periods. It is just a spot on the chart that averaged out the last 200 candles, and price will often get to it. Always in forums, always everywhere that you see on Forex something, that lagging indicator comes up. And my question is always, as opposed to what? And there's never an answer to that. They think lagging indicators are bad. Well, if you want an indicator that doesn't lag, the only thing I can do is put a 1 period exponential moving average on my chart. And that is going to show you, and that's basically a line graph, line chart. And that is of no use. You cannot use that in any way because that's what the candles are doing. So the lagging indicators serve a purpose. If you know how to use them, they serve a purpose well, and they do a very good job. But it all comes down to how they're used. People that can't use a MACD say they don't work. People that can't use a stochastic says it doesn't work. People that can't use moving averages say they don't work. Once you learn how they work, then they work. Once you know how to use them, then they're okay now. But it's that whole understanding of what it is you're looking at and how can I use it to my advantage that makes it work. The lagging indicators, I wouldn't have it any other way. Pivot points, do they provide valid targets? Adrian is telling me time is up, and it is up. Pivot points, I am not a fan of pivot points. However, I do know traders that love them and say that they do provide good targets. I've never really taken to them. I've tried them, and if you can use them and make them work for you, then by all means. They don't get in the way of anything. It's not cluttering stuff up. It's just giving you valid targets. If you're finding that they work for you, by all means, do it. For me, though, it's been a hit or miss. The 50 period TBL, John, why do I like it better than 20 or 36 or whatever the case is? The 50 period is institutional. It is what banks use, and it is what hedge funds use. And we might as well be using the same sort of numbers that they use, because the guys that move the biggest money, the ones that actually can move the market, are using these kinds of numbers. So if we're going to be, we might as well be going with the current instead of swimming against it. And that is what this is. We are going to take advantage of what is happening. We are going to ride the coattails. As awful as this to say, we don't have the power to do anything in this market. All we can do is take advantage of what's happening. We cannot make the market move. We have no control over it. But there are people that do. And we might as well be taking advantage of them. We have kind of an inside scoop when it comes to that, using this kind of moving average or this kind of period setting. Okay, guys, I hate to cut it as it is. It's 20 minutes over. I was hoping to be done 20 minutes ago. For me and for you, this webinar is recorded and it is going to be uploaded in 24 hours. So we're going to start seeing some posts, I hope, in the forum. Ultimate trade setups. I love those. And support and resistance levels. Why didn't this trade work out? You butted up against support. You butted up against resistance. Why didn't this trade work out? Well, check the trend line. This is all part of a process. And I hope that you're seeing now that if this was all introduced at the exact same time, because I do get questions about that. Why don't you just give everybody everything all at once? That if that was the case, if everybody got access to everything at once, that this would make, it would be so much. It'd be so overwhelming that it wouldn't make any sense. It all seems contra. It all seems to be counter. It all fights against each other if you don't know how to apply it kind of piece by piece by piece. So this is how we're doing this. And I hope that it makes sense. And every little aspect that we add, because I know some traders are struggling right now, and it's going to get better. Every time you can add one more piece to the puzzle, it's going to get better. You're going to get better results. You're going to start taking fewer trades. It's not like you're looking less, but the trade number is going to start reducing. But as a result, the number of wins are going to start increasing proportionally. So instead of taking 10 trades and winning 5 and losing 5, you're going to be taking 7 trades and winning 4 and losing 3. You're going to get that kind of skew. Those sort of numbers are going to start changing that way. So you're going to start taking 5 trades and winning 4 and losing 1. And I would much rather have those odds than taking 3 times as many trades and still ending up at break even. So that is what all of this does. It's important information, but it's too much to be delivered all at once, and it won't make any sense. So I hope after today, it does make sense, or starts to make sense. And the forum, we're going to start seeing more and more images of trend lines, more and more images of support resistance levels, and so on. And they are going to start making more sense. Thanks, guys. I hope the PowerPoints are understandable. I like doing the live chart stuff, but with the PowerPoint, I'm able to get my thoughts down a little clearer. And I hope the way I read them, kind of emphasis, I'm a little bit self-conscious about that because I have a difficult time reading a script. So so I hope that the PowerPoints come across okay, that they're understandable, and they make some kind of sense. And again, if you've got questions, the forum is the place to go. Ask your questions. They will be answered. And I'll answer them. And if it doesn't make sense the first time, ask again, and 3 times, 4 times. There's some members that do, and it's okay. We'll get it perfect. Like, we'll keep answering that question until you get it. And on that note, I do have to take off now. So, that is a good. Rasheen, sorry about that. We didn't even cover that. Okay, I'm going to be giving you this indicator. This is an indicator called SRT, support, resistance, trend lines. So what it's going to do is it gives you areas of recent support or resistance. And now, I don't know how well these are coming through in the video. We have red lines and green lines, and they're darker in color simply so that they don't get in the way of my charts too much. But they are going to provide you with areas of recent support and resistance levels. They're going to be good for if you want to give your stop loss a little bit wider, you're looking for some targets, they're going to help you with some of that. What it will do is also give you two trend lines, the most recent up and the most recent down trend line. Now you can turn stuff off. You can turn the trend lines off. This is a hide trend line. Yeah, I want to hide the trend lines. You can turn them off, or you can go the other way. You can turn off the SRT levels, turn the trend lines on, and just show that. So that's going to give you the most recent trend lines as best as a computer can do it. Now they're based entirely on fractals, 9-period fractals. And for me, the 9-period fractal does a really nice job of identifying highs and lows as far as the swings go, which give you really good areas of support and resistance. That is going to be made available to you. We can cover that a little bit more. Glad you brought that up because it totally I missed that. So I'm going to, again, we'll make this available to you. It's a handy little indicator, and it's going to help you stay out of some trades that maybe you would take anyways. All right, guys, come to the forum. I'm going to make sure that there's some more information, and I will see you next week. So if I don't see you in the forum, I will see you in the week to follow. Next week, same time, same place. It's another very cool topic, and I will see you then. Holla the slanted trend lines. You can get rid of them so they don't clutter the chart anymore. All right, guys, you take care, and I will see you, well, in a week for sure. Bye, guys.